Liquidity pockets are one of the most powerful concepts in trading. They reveal where the market is likely to reverse and provide high probability setups for consistent profits. In this video, I will explain what liquidity pockets are, how to identify a valid one, why they are important, and how you can trade them effectively using my PSS model. So let's get right into it. So first thing first, what are liquidity pockets? Liquidity pockets are zones on the chart where a large number of stop losses or pending orders are concentrated. These zones act as magnet for price as institutions target them to create liquidity needed for their massive trades. Think of them as untapped fuel tanks for the market. Once price taps into the zones, we often see sharp reversals. And what defines a good liquidity pocket? A good liquidity pocket is defined by price action that makes a new swing high or low. Here's the rule that you need to follow. If price makes a new swing high, breaking above prior swing highs, the recent swing low that helped price push to the new swing high becomes a valid liquidity pocket. Similarly, if price makes a new swing low, breaking below prior swing lows, the recent swing high becomes a liquidity pocket. This means institutions use that area to generate enough buying or selling pressure to create new highs or low. And what considers as invalid liquidity pockets? If price does not break above or below prior swing highs or low, the liquidity pocket is not valid. Without that break, there's no confirmation that the zone holds significant institutional order. We will look for price to revisit these valid liquidity pockets in the future, giving us a potential high probability entry points for our trades. Liquidity pockets matter because they show us where the institution's orders are active. While retail traders often get trapped in these zones, small traders use them to enter trades alongside with big players. When price sweeps the liquidity pocket, it clears out retail stops, creates the condition for a strong reversals. That's where the high probability setups are born, and that's where we're going to enter about most of the trades. Without understanding liquidity pockets, you are trading blind, but with them, you have a roadmap to anticipate the market moves. Now you understand the basics of liquidity pockets, how to identify them, but now let's move into how to trade liquidity pockets using my PSS model. Step 1, spot the liquidity pocket. Start by identifying valid liquidity pocket zones where price made a new swing high or low by breaking prior levels. These pockets hold significant orders left by institutions. As we discussed earlier, these pockets act as magnet for future price action and are the foundation of our setup. Step 2, wait for liquidity sweep. Be patient, don't jump in just because you see price tapping the liquidity pocket. You want to see some sort of rejection or a liquidity sweep of prior swing highs to enter into your trades. Step 3, look for a directional shift in the market. After the liquidity sweep, wait for confirmation that the trend is reversing. This is what I call directional shift. For bullish reversals, price must break above the previous swing highs, confirming buyers are stepping in. And for bearish reversal, price must break below recent swing lows, confirming sellers are in control. This directional shift separates high probability setups from traps. Step 4, and it's a crucial one, confirming the structure breakpoint. After the directional shift, wait for price to form a pullback and create a new structure point. In an uptrend, this would be higher lows after a sweep. In a downtrend, this would be lower highs after the sweep. The SBP is your confirmation that the trend has officially shifted, and now you can enter your trade on a pullback into a high value zone. Use Fibonacci retracement from the recent swing high to swing low or vice versa. The ideal entry point lies within the high value zone, typically between 50% and 61.8% retracement levels. This is where price often pulls back before continuing in the direction of a new trend. Enter the trade when price taps into this high value zone, and always set your stop loss just beyond the liquidity sweep candle high or low, and your target should be the next swing high or low where the opposite liquidity resides. This ensures you're taking profit at a logical level and not at just any random level. For a larger move, trail your stop loss as price creates a new structure, higher highs and higher lows in an uptrend and lower lows and lower highs in a downtrend. That's exactly how you trail liquidity pockets using my PSS model, which has over 80% win rate. If you want me to see live trading this model every single day in hundreds of people and benefit from it too, then click the first link in the description below to claim your free 7-day trial to the premium Discord.